Hello and welcome to the monthly market report for February 2022. My name is Marshall Remington Pettygrove, and today I'm going to be walking you through three of what I think is the most important topics in the housing market right now. We're going to be talking about homeownership as a hedge against inflation. We're going to be talking about rising mortgage rates and the latest update that we have on the forbearance situation. So let's begin with the first topic here, homeownership as a hedge against inflation. Now, why is this important for us to be talking about? Well, as we see prices rise around us at the gas pumps, at the grocery store, homeownership certainly not immune to that in any way, and neither is rents, which we're going to talk about as well. But one of the things we want to focus on is how locking in someone's fixed monthly cost, their biggest cost that they have in homeownership, at today's price is so beneficial to safeguarding someone and essentially hedging against inflation and that rising cost around us and going forward. So I want to begin with a quote from Investopedia. It says that real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns. Unlike paper assets, more specifically, as prices rise, so do property values. So what we can see here is that homeownership is one of those things that you can lock in the cost today. It's an asset that's increasing in value in time. And as prices rise and home values rise and all the prices around us rise, locking in that fixed cost in home ownership is a real game changer as a hedge against inflation for tomorrow. So what I want to do on this next slide is show you a visual that really depicts what we're talking about, home ownership outperforming inflation over time. So let's take a look at the slide here. This is homeownership as a hedge against inflation, and I want to break it down for you so you can really see what we're talking about here. This is home price appreciation versus consumer price increase over the decades. And as it goes all the way back to 1970s, now what we're looking at here is the blue bars are the average inflation rate for the decade, and the green bars are the average home price appreciation for each of those decades as well. Let's look at the 1970s to start. Inflation increased at 7.1% in that decade, and home values appreciated at 9.9% in that same time period. So home ownership outperforming inflation, and where do you want to be in inflation times is the asset that's outperforming inflation, right? Now in the 80s, it was a little bit more balanced, 5.6% inflation, 5.5% home appreciation. And you look at the 90s, we start to see home values tick up again a little bit more, outperforming inflation throughout that decade. Now we know the 2000s were very different. Home prices performed at a very different rate than we've seen in many other decades, and even what we're seeing today and potentially tomorrow. We also had a fundamentally different housing market. We had the oversupply of homes. We had lending standards that were vastly different than they are today. Homeowners didn't have the equity that they have in their homes right now. So fundamentally a different market, one where we're not headed going forward. So home prices did not outperform inflation in the 2000s, but you look at the 2010s, this is where home values really start to tick up. Homes started appreciating much faster than inflation, 4.9% versus 1.8%, and then 2020, 2021, what happened here, massive home price appreciation, a drastic difference where home values outperformed inflation. So over time, what you can see is that home ownership is generally looked at as this great hedge against inflation, because home values are performing better than inflation on an average. That means that somebody buying a home today can lock in today's cost and protect themselves against the rising cost of inflation in that biggest monthly payment that they have going forward, which is super powerful. Now, this becomes really important when we start to talk about renting, because renting takes on the risk of rising rental prices year after year after year. And I've shown you that data if you've been following along with me, how rental prices are truly skyrocketing. So let me share a quote with you here that's really powerful for renters, in my opinion. This is from Bankrate, and it says, a fixed rate mortgage allows you to maintain the biggest portion of housing expenses as the same payment. Sure, some property taxes will rise and expenses may, creep up, but your monthly housing payment remains the same. That's certainly not the case if you're renting, and that's because rental prices rise year after year. So this becomes really powerful for someone who might be, sitting here going, I could buy today, but I'm kind of going to put it on pause and I'm going to wait. I'm going to wait and see, kind of what happens with home values, if they drop, if they rise. Well, all the forecasters that I've seen are showing home values are projected to continue to rise. We also know that mortgage rates are projected to keep rising, and we know that rental prices are rising. So what does that mean at the end of the day? Well, someone who continues to rent but could buy is taking on that additional increase in rent year after year. Plus, it's going to cost more to buy, down the road as well. So it's really important for renters to understand this dynamic. And I think this next visual really helps show how rental prices compare to inflation rate. So this slide shows that rent increases have been greater than inflation in most years. So let me break it down. Rental price appreciation versus core inflation rate. Again, going all the way back to the 70s. So your blue line is that core inflation rate, and your green line is that rental price appreciation. And what do you see on a whole here? The green line higher than the blue line in most scenarios, meaning that rental prices have increased at a faster rate than inflation in most times. Yeah, there's some ticks down below that blue line. However, that means it's more expensive to rent on average over time because rental prices are continuing to rise faster than the rate of inflation. So when I have this conversation with renters, it becomes mission critical that they understand the dynamic of buying now if they can, to avoid those increases cost for rent and inflation all around us. So let me go ahead and share this quote. I think this really kind of brings it home for us, and this is from Forbes. It says, homeowners are shielded from mounting rental prices because their cost is fixed. Regardless of what's happening in the market, they're locking in that payment at today's cost. Tangible assets like real estate get more valuable over time. You've seen that in the graphs and the data that I've shown you, which makes buying a home a good way to spend your money during inflationary times. I've talked a lot about home price appreciation, and I'm sure you kind of want to know where that's headed. So as we have this conversation and we think about rising prices and how homes aren't immune to those increases, let's take a look at this next graph from the Home Price Expectation Survey. And I think this gives you a really clear picture of where home prices are projected to head according to the experts. Now, as you can see, the Home Price Expectation Survey is a survey of 100 economists, data analysts, people who are projecting out home price appreciation. And in the fourth quarter of last year, this is the projection for cumulatively house appreciation by 2026. So what you're looking at, they divided out the group into optimists and pessimists. Optimists being the ones projecting the most appreciation over the next 5 years, and pessimists obviously estimating the lower side of things. So take a look at the orange bar. Those are the pessimists, the experts that are saying, home price appreciation on the lower side cumulatively by 2026, it's going to be over 23%. So as experts look forward, what's projected to happen, home values are expected to increase in value over time. Even on the lower end, 23%, 23.7% is pretty significant over the next 5 years. So locking in today's cost is mission critical for those who have the opportunity to do so. to protect themselves in their largest monthly payment. Because as we know, with home prices rising, mortgage rates rising, inflation all around us rising, it's going to get more expensive to purchase a home. So I'm going to pause here and talk a little bit more on mortgage rates. We're at the beginning of February, and certainly, we've seen those mortgage rates in a volatile environment. So I'm going to cover where we're at today, but certainly as we go through the month, I'm going to keep you updated on what's happening with mortgage rates as well. So let's start right here. Sam Qatar from Freddie Mac says mortgage rates remained unchanged from last week. The economy lost momentum in January, leaving mortgage rates unchanged from last week and relatively flat for the third consecutive week. This stagnation reflects the economic impact of the Omicron variant of COVID-19, which we believe will subside in the coming months. As economic recovery continues going into the spring and summer, mortgage rates are expected to resume their upward trajectory. In the meantime, recent data suggests that home buyer demand continues to be elevated as supply remains low, driving higher home prices. This statement came out, I believe, days before the job report that Friday. And certainly, I think a positive job report hints to the Fed taking action in raising the Fed funds rate in March. So expect to see those rates go up. Today, as we record this, we're at about 3.55% on the average 30-year fixed, as recorded by Freddie Mac. But no doubt, a volatile January leading into a February that I believe will see more rise in rates. And that's what we need to be prepared for. So my goal over the next, couple minutes here is to give you what you need to accurately understand that. So if we look at the rise in rates, we're at about 3.55% on the day we're recording this. And this graphic we're looking at, it goes back to the beginning of 2020. And as you can see, we're starting to get back in that area of where we started when the pandemic came on us in March of 2020. And just to put that in perspective, right? The Fed comes in, they act, they influence, they don't control mortgage rates, right? But they influence the rates down, and now we're coming back up. So certainly a sign that we can all hope for that the economy is improving and that we're getting through this and we're moving ahead, right? If you take a little bit larger look, if you go back to the beginning of 2018, which is what this slide shows, the average 30-year fixed, and sort of make a line at this 3.55%. You can see where we sit. Certainly we're higher back in 2018. In 2019, started to kind of come down and certainly drop to historic lows during the pandemic. And we're starting to come, back out of that. Here's some perspective on that, again, from Freddie Mac. As mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. So no doubt we'll see a housing market that is competitive this year. It goes on to say in 2022, we expect to see purchase originations to grow from 1.9 trillion in 2021 to 2.1 trillion in 2022, while refinance activity is anticipated to decrease from 2.7 trillion in 2021 to 1.2 trillion in 2022. So why is this important? Look at the two mortgage markets. You have the purchase market and you have the refinance market. The purchase market forecasted to grow, refinance market forecasted to constrict. And that makes sense, right? In a rising rate environment, everybody had the chance, well, maybe not everybody, but to have that chance to refinanced at a record low rate, and good for them, as homeowners, to be able to do that. But we're going to see the refinance volume constrict. Why is this important right now? Well, homeowners are going to see the headlines that talk about the overall mortgage market constricting. The hyper state of awareness we all get in when we're thinking about something, doing something. You start recognizing every article, every headline that's out there. So you need to understand this topic if you're buying a home to have a clear perspective. The purchase market is going to grow. The refinance market is going to constrict. And let's keep that in perspective as we continue into this real estate year. If you take this rate of 3.55% and even going into 4%, which I think we'll see very soon, that's still a very, very favorable rate. When you go back all the way to the 70s, this is the average 30-year fixed by decade, going 1970, 80, 90, 2000s, 2010. And what do you see there at 3.55% or even 4%? Very, very favorable financing when you look historically. I've mentioned it before, between 2010 and 2020, we bounced around 3.5 to 5% was really that range of interest rate during those times. So you see the average rate here of 2010 of that decade, 4.09%, very, very good financing. So it's gonna feel like we're heading higher, but when we look historically, still very, very good financing for homes across the country. So the last two slides that I wanna show you really kind of position what you need to know around interest rates in this market. Many are asked about interest rates and they may not have an opinion on it and say, well, gosh, they're going higher and we're just gonna have to wait and see, right? But here's what you need to be looking at for the rate conversation. So this is a look at the 10-year Treasury, going back to the beginning of December, right? Just 2 months ago. And what we know, right? So during that time, the rate on the 10-year Treasury yield has skyrocketed, knocking on the door right around, now of 2%. Why is this important? Here's why it's important. For the last 50 years, the relationship between the mortgage rate and the 10-year Treasury yield has been almost symbiotic, okay? Wherever the 10-year Treasury yield goes, there goes the 30-year fixed rate, okay? So, the Fed and the Fed raising interest rates does not control interest rates, right? It can only hope to influence it. And what we wanna watch is the 10-year Treasury yield. So understand this rate conversation and keep an eye on the 10-year Treasury is important. Why is that? Because over the past 50 years, again, there's been a relationship between the 10-year Treasury and the 30-year fixed loan. And I'm staying on top of this, you should as well. Even to take this a step further, what I would do is I would look at where we started the year at about 3.1%, where we're right now at about 3.5% and where we're going, around 4%. And I'm not gonna, say we're going to stop at 4. I don't have a crystal ball that's better than anybody else's, but that's certainly the outlook. And I would take the average loan amount in your area. Maybe you get this from, a lender partner of yours, have them do the calculation. What was the payment at the beginning of the year? What's the payment now? And what's the payment at 4%? And it's gonna show you the real impact of moving interest rates. I'm not trying to convince anybody to do anything that they don't want to, right? But I do want to educate them on what's really happening in the markets right now. Now, I'll end the mortgage talk on this slide here. Mortgage rates hit their highest level since March of 2020, leading to a slowest pace of refinance activity in over 2 years. The market in the last few years, the mortgage market certainly has had a ton of refinances in it. Those are going away. And my advice to you is to have a great lender that really serves you as a buyer in the best possible way going forward. It's extremely important, in my opinion. Now, the next topic, the last one we're gonna walk through today, is our latest update on forbearance. This is something that I've been following along with for a while and sharing with you, and I think today's data is really gonna help articulate why we'll not see this wave of foreclosures coming to the market. Now, I want to begin today with an update on how many loans are in the forbearance program. So take a look at this slide. This graph right here, I've shared it before. Loans in forbearance have fallen below 1 million. This is massive. We're at roughly 780,000 loans in forbearance today, and that equates to only about 1.4% of mortgages. If you think about where we started over there in the red bars on the left, there were nearly 5 million homes in forbearance plan in May of 2020, and we're down to about 780,000. So huge progress, and just one way that shows that the forbearance program really has helped homeowners change their situation, stay in their homes, and really be in a better place than they would have been in such a time of economic uncertainty. And this is vastly different, let me point out, than what we saw in 2008. I want to share a quote with you from Black Knight that says, "As the COVID-19 pandemic continues to create uncertainty in the global economy, the overwhelming majority, 89%, of single-family homeowners who sought financial assistance through COVID-related mortgage payment forbearance plans have exited those plans." So many people, 89% of the people who went into the forbearance plan have exited, and that is massive. That's massive improvement. What I want to share today is that you've probably seen this before. This is loans upon exiting forbearance program. That's what this graph is showing. And I want to break this down because this really walks you through what's happening as people are exiting the program today. Take a look at the green section and let's start there. So 38.1% of homeowners exiting the forbearance plan are paid in full. So they've made their monthly payments or they've paid off their loan. They've done something to bring their payments current and they're in a great place. They're walking away with no issues. Now, 43.7% are workouts or repayment plans, and that's that blue section. And this is the game-changing section that we didn't have last time around when the housing bubble burst, because those are the homeowners who have been able to make modifications, a loan deferral, whatever it may be, to go back to their bank and work with their bank or their lender to change their situation and stay in their homes. This is huge. And what I've been saying over this time is this blue section is getting a little bit bigger than the green section, and that's because more and more people have been able to go back and work out an alternate plan. And that's massive. Now, the percentage of homeowners that are still in trouble are in the orange section, 18.2%. But what this does mean is that these homeowners are exiting the plan without a loss mitigation plan. But on the safe side, what we know from Black Knight is that 93% of homeowners in the forbearance plan have at least 10% equity. So when you have that kind of equity, you also have the opportunity to potentially sell your home rather than go into foreclosure. People sitting in this situation with 10% equity is kind of the tipping point, right? Where you could sell your home, you could pay off your fees, you could even maybe walk away with a little cash in your pocket if you sell your home. And so that gives someone a different opportunity than going into foreclosure, right? We have a very strong equity position across the country right now, enabling that opportunity. So as we look at this graph and we talk about how many homeowners are exiting the plan, what's happening? The reality is that about 4 out of 5 homeowners are walking away just fine. Now, where I want to bring some additional context to this is in what the foreclosure situation looks like in a typical year in the US. Because I think this is really going to start to shape what we're talking about today versus what we had in 2008. Let me remind you, I've shared with you the quote many times on how 9.3 million homes went into foreclosure the last time around when the housing bubble burst. And we're in a very different situation now. So remember that 9.3 million as we walk through, this next slide. And what this says here is that 422,360 fewer foreclosures over the last year. So we have significantly fewer foreclosures today than we would even in a normal year. So let me break it down for you. Look at those first 3 red bars, the taller ones on the left. That's 2017, 18, and 19. The number of foreclosures we had in those normal years leading up to the pandemic averaged just under 300,000. And so the unfortunate reality is that in this country, every year there are homeowners who, do go into the foreclosure process. They lost a job or a challenging financial situation. Something happens where homeowners have to give their homes back to the bank or the lender. And in 2017 through 2019, that number averaged out to about 290,000 foreclosures. Now, if you look at 2020 and 2021, these were not normal years. This is where the forbearance program came into play, and there were, far fewer foreclosures in each of those years. So if you look at the red bars under 2020, there were 120,000 foreclosures in 2020, and that was, short 161,000 on what would be normal. 2020 through the third quarter is what we have data for right now, which is 29,000, so massively short. So that's where that 422,360 foreclosure number comes from. And contextually, if you think about that, that is incredibly low. In fact, it is so low that I think this next graph really shows it well. Foreclosure activity is actually at an all-time low. So look at the numbers over on the right side of the screen, 2021, where we are so far. There are 151 foreclosure filings. Now, we never want any homeowner to go through the foreclosure process, right? We certainly don't want that to happen. We believe in home ownership. I believe in home ownership and the value that it brings everyone. But if you put this into context and you look at those red bars, 2007 to 2015, millions of homeowners were going into the foreclosure process. And that is vastly different from where we are today. I mean, even in this number of 151,000, if it doubles, if it triples, if it quadruples, and it keeps going, we're nowhere near where we were when the housing bubble burst the last time around. And this is massively impactful, showing that the fundamentals of today's market are just very, very different today. So now I want to end with this quote because I think it really kind of brings it all home. This is from CoreLogic, and it says, "We may see a little bit of an uptick in foreclosure rates in 2022, just an uptick though. From an extraordinary low level, we're not expecting to see a big increase. We expect to see delinquency rates overall on home mortgages to actually continue to remain quite low." That's exactly where we are today. The number of homes going into the foreclosure process, nothing like we saw in the housing crisis in 2008. Thanks to the forbearance program that gave homeowners the mortgage relief that they needed when they needed it most. So I'm going to end right here. Thank you so much for joining the monthly market report. I do have one quick update for you. I have a spring buyer and seller guide coming out March 4th, 2020. It's a fantastic free resource to you with hyper-relevant information on real estate market on a macro level. All the latest that you need to know, whether you're a buyer or seller, to help you feel confident in the coming spring market. So thank you again for joining me today. I hope these visuals were powerful, and I hope you download the guides when they come out in March. And we'll see you next time. Thank you so much.